Making sense of money, why mutual funds and ETFs matter, investing. It's a word that can evoke both excitement and trepidation. We all want our money to grow, but the world of finance can seem like a complex maze. Fortunately, there are straightforward ways to make your money work for you, and that's where mutual funds and ETFs come in. Mutual funds and ETFs pool money from multiple investors to invest in a diversified portfolio of assets. These assets can include stocks, bonds, and other securities, providing an easy way to access a wide range of investments. Mutual funds and ETFs offer a gateway to long-term growth potential, allowing you to participate in the market without being a financial expert. Understanding these tools can empower you to make informed decisions and build a brighter financial future.
Imagine a basket filled with a variety of fruits. You have apples, oranges, bananas, and grapes, each adding value and flavor. Mutual funds work similarly, pooling money from investors to create a diversified portfolio. They allow you to buy a share of a professionally managed portfolio. One key advantage is instant diversification. Investing in a mutual fund gives you exposure to a wide range of assets, reducing risk. Plus, they offer professional management by experienced portfolio managers. However, mutual funds have drawbacks. They charge annual fees, which can reduce returns. Prices update once a day, limiting flexibility. Despite this, mutual funds are popular for convenient, diversified investing. Exchange-traded funds, or ETFs, share similarities with mutual funds in that they offer investors access to a diversified portfolio of assets. However, ETFs differ in their structure and trading mechanics, providing investors with unique advantages. ETFs are similar to mutual funds in that they offer a basket of investments, but they trade on stock exchanges like individual stocks. This key distinction means that ETF prices fluctuate throughout the trading day, just like any other publicly traded security. One of the most appealing aspects of ETFs is their flexibility. Investors can buy and sell ETFs throughout the trading day, allowing for greater control and the ability to react to market movements. Additionally, ETFs tend to have lower expense ratios compared to mutual funds, making them a more cost-effective investment option over the long term. However, it's essential to consider the potential drawbacks of ETFs. While their intraday trading flexibility can be advantageous, it also introduces the possibility of impulsive trading decisions. It's crucial to approach ETF investing with a well-defined strategy to avoid emotional decisions driven by short-term market fluctuations.
When it comes to investing, understanding the costs involved is paramount. Both mutual funds and ETFs come with fees, and knowing how these fees are structured can impact your overall returns. Mutual funds typically charge annual expense ratios, which cover the costs of managing the fund, administrative expenses, and other operational costs. These ratios are expressed as a percentage of your investment, so a fund with an expense ratio of 1% would deduct 1% of your investment value each year. ETFs, on the other hand, tend to have lower expense ratios compared to mutual funds. This is because ETFs are passively managed, meaning they track a specific index or basket of assets, requiring less active trading and management. In addition to expense ratios, investors should be aware of other potential fees, such as trading commissions, which are charged by brokerage firms for executing trades. Some brokerage firms offer commission-free trading on certain ETFs, which can significantly reduce your investment costs.
Section 5. Mutual funds versus ETFs, a head-to-head comparison. Now that we've explored the characteristics of mutual funds and ETFs individually, let's compare these investment vehicles side by side to understand their key differences. One of the most significant distinctions lies in their trading mechanisms. Mutual funds are priced once a day at the end of the trading day, while ETFs trade throughout the day, just like individual stocks. This difference in pricing structure impacts the flexibility and control investors have over their investments. Another key difference is their fee structure. Mutual funds typically have higher expense ratios compared to ETFs, which can impact your overall returns over time. However, some mutual funds may offer lower investment minimums compared to ETFs, making them more accessible to investors with limited capital. Ultimately, the best investment choice for you depends on your individual financial goals, risk tolerance, and investment timeline.
Section 6. Finding the right fit. Which option aligns with your goals? With a clearer understanding of mutual funds and ETFs, you're better equipped to determine which investment vehicle aligns with your financial goals. If you're seeking a hands-off approach to investing and prefer to delegate investment decisions to professionals, mutual funds may be a suitable option. Their professional management and diversification benefits can provide peace of mind, especially for investors who are new to the market or have limited time to dedicate to managing their investments. On the other hand, if you prefer greater control over your investments, value flexibility, and seek lower costs, ETFs might be a better fit. Their intraday trading capabilities and typically lower expense ratios empower investors to take a more active role in managing their portfolios. Before making any investment decisions, it's crucial to carefully consider your investment timeline, risk tolerance, and financial goals. Consulting with a qualified financial advisor can provide personalized guidance and ensure your investment choices align with your overall financial plan.
Section 7. Real-world examples, putting investments into context. To illustrate the practical implications of investing in mutual funds and ETFs, let's consider a few real-world examples. Imagine Sarah, a young professional just starting her investment journey. Sarah wants to invest in a diversified portfolio of stocks, but doesn't have the time or expertise to research individual companies. In this case, Sarah could invest in a broad market ETF that tracks the S&P 500 index, providing her with exposure to 500 of the largest publicly traded US companies. Now let's consider John, a retiree seeking a steady stream of income from his investments. John could invest in a bond mutual fund that focuses on generating regular interest payments. The fund manager would handle all investment decisions, providing John with a relatively low-maintenance way to supplement his retirement income. These examples highlight the versatility of mutual funds and ETFs, demonstrating how they can be tailored to meet the unique needs and goals of different investors.
Section 8. Tax implications navigating the financial maze. While investing offers the potential for growth, it's essential to consider the tax implications associated with your investment choices. Both mutual funds and ETFs can impact your tax liability, and understanding these nuances can help you optimize your returns. Mutual funds are known for their potential to generate taxable dividends and capital gains distributions, even if you don't sell your shares. These distributions represent your portion of the fund's profits and are taxed at your ordinary income tax rate. ETFs, on the other hand, tend to be more tax efficient compared to mutual funds. This is because ETFs are structured in a way that minimizes taxable distributions. However, it's important to note that you'll still owe capital gains tax on any profits you realize when you sell your ETF shares.
Section 9. Diversification and risk management. Safeguarding your portfolio. One of the fundamental principles of investing is diversification, which involves spreading your investments across different asset classes, industries, and geographic regions. Both mutual funds and ETFs offer inherent diversification benefits, reducing the impact of any single investment on your overall portfolio. By investing in a diversified portfolio, you reduce the risk of significant losses if a particular asset class or company underperforms. For example, if you invest all your money in a single stock and that stock plummets in value, your entire portfolio would suffer. However, if you had invested in a diversified mutual fund or ETF, the impact of that single stock's decline would be cushioned by the performance of the other holdings in the portfolio.
Section 10. The power of long-term growth investing for the future. Investing is not about getting rich quick. It's about making strategic decisions today to secure your financial future. Both mutual funds and ETFs offer the potential for long-term growth, allowing you to harness the power of compounding returns. Compounding is the process by which your investment earnings generate even more earnings over time. As your investments grow, your earnings are reinvested, creating a snowball effect that can lead to significant wealth accumulation over the long term. The key to unlocking the power of compounding is to start early and stay invested. The earlier you begin investing, the more time your money has to grow, and the greater the potential for compounding returns.
Section 11. Making informed decisions, empowering your financial journey. In the realm of personal finance, knowledge is power. By understanding the intricacies of mutual funds and ETFs, you empower yourself to make informed investment decisions that align with your financial goals. Remember that there is no one-size-fits-all answer when it comes to choosing between these investment vehicles. The best option for you depends on your individual circumstances, risk tolerance, and investment timeline. Take the time to carefully consider your options, conduct thorough research, and seek guidance from a qualified financial advisor if needed. By taking a proactive approach to your financial well-being, you can pave the way for a brighter and more secure future.